This is the lab on responsibility accounting. For our problem, we will have one company, Galactic Harmony LLC, with an investment center and a profit center. The company also has two divisions, CDs and shows, and two products, A and B. Here is the data for the investment center. Notice the common costs are not allocated to the divisions, but from the total for Galactic Harmony. When you set up the problems, remember to format the spreadsheet for currency with and without dollar signs. Then you will only need to format the percentages for those numbers using percents. Doing that first will help align everything properly. Here is the information for the data centers within the CD division. Notice that the common costs are not allocated by product. And yet, the net income for both products totals the net income for the CDs division. It's the same as we did for the last slide. Now, the company plans to initiate a marketing campaign for one of the two products in the CDs division. The campaign would cost $3,000 per month, and it's expected to increase the sales of whichever product is advertised by $25,000 per month. Compute the expected increase in the responsibility margin for each product in the CDs division, assuming that 1, product A is advertised, and 2, product B is advertised. If you're only going to advertise one product, this analysis lets you know which one should be advertised. Once the problem is organized, the solution is easy. We are just looking at the margin, so we only use the expected increase in sales. Then, for each product, we multiply the increase in sales by the product contribution margin ratio. Remember, these are based on variable costs, so the increase in sales results in a proportionate increase in variable costs and in the contribution margin. So, after using those percentages, we have the expected increase in the contribution margin. From there, we subtract the expected change in fixed costs from the marketing campaign we're analyzing. And the result is the expected change in the responsibility margin. With an increase in the monthly marketing costs, product B has also an increase in the responsibility margin of $3,875, while product B increases a lot more, and the increase is $5,750. From there, we can now prepare an income statement for Galactic Harmony. We can do it by division and then total it for the company. Since we worked on the CDs division earlier, let's use the show division and pretend it's the first month of the new marketing campaign. Had the monthly sales in the show division increased by $20,000. So, what would the new income statement by division look like? When you set this up, remember, while we estimated changes in the CDs division from the marketing campaign, we weren't told that the numbers changed, so we used the same information without additional marketing numbers. But for Division 2, we do have the increase in sales of $20,000. And don't forget that the variable cost changed. Since we have a variable cost based on sales, and we know that the increase in sales will increase the cost of the items sold, we calculate the change in the variable cost by using the same percentage as we used earlier. We don't have the same change in fixed costs because fixed costs are not related to sales. Fixed costs by division does not reflect a change in sales. Finally, the common costs are not by division, so they are only used in the company total. So here is the responsibility income statement showing the income attributable by division and in total. That's it for this lab. Please let me know if you have any questions.